Hello, my name is Aaron Edwards, co-founder and market consultant of Santos Springs. We offer grain marketing solutions to producers in multiple countries. Welcome to our W2H grain marketing channel. Go ahead and hit the subscribe button. I also recommend tapping the bell so you get future notifications. And if you like what you see, hit the like and share this video with other farmers who care deeply about their grain marketing. If you are a corn or soybean farmer, your revenue depends not only on your production, but also the answer to three simple questions: when, how much, and how you sell. One W, when, two H's, how and how much. Our W2H mentorship provides a clear, concise, and custom approach to answering each one of these three questions for your specific farm throughout the year. Before we start this week's content, it's always important to remember that trading in futures products entails significant risk of loss, which must be understood prior to trading and may not be appropriate for all investors. This commentary and the information contained within should be considered market commentary and reflect the opinions of the author. For those of you watching this with a delay, if you are a U.S. corn or soybean farmer and want to stop being held hostage by market uncertainty, let us teach you how to place each one of your bushels in a grain marketing strategy specifically designed to optimize your farm's revenue. Click on the link and we'll work together to see if our W2H mentorship is the right next step for your grain marketing.
This is Aaron Edwards, Santos Springs, February 24th, 2025. We've got a lot to cover. We want to talk about the corn and bean ratio coming in to our March battle for acres. We want to talk about beans are looking toppy, but we actually need them to move quite a bit higher to get some optimism. So there's a lot to cover. But first, let's start with the recommendations, that call to action. Let me go ahead and share the screen to go over that. All right, so let me grab a marker. It'll be a little easier to get this all marked up. So we want to go, we'll do yellow here for corn. So if you've been following along, chances are you have some March corn calls. So if you have those March corn calls, they're expiring, right? We're down to the wire on that. We're going to replace those, whatever you have in volume, replace those March calls with May futures. We want to stay long this corn market. It makes sense to stay long coming into the spring. So we're going to go out to the May. The other thing is we've been looking for good opportunities to roll from March to May. We haven't gotten that spread we were looking for. So contracts, the calendar's running out. We just have to roll. So if you have basis contracts, you probably have March or May or maybe a combination of both. If you have March contracts, if you have May, don't worry about it. If you have March contracts, let's get those rolled to the May. That's the second action item. We want to stay, keep our sights higher coming into the spring. We want to stay, keep upside potential. And then the last thing, and I'll switch to green to this, is soybeans. And it's the HTA on 20% of the spring delivery, Q2 delivery soybeans. So again, these are beans. Just think about it for the sake of simplicity. Let's say you have beans in the bin and you can hold those until the spring. I don't really have to move them. All right. To this day, in this crop year, I haven't recommended touching those bins. We've dealt with the beans that are in town, which are our fall beans. We've dealt with our winter delivery beans we wanted to be moving throughout the winter. We haven't yet made a recommendation on spring until now, on spring delivery beans. And we're not going overboard. The reason for the HTA is I still think we have more upside than downside on the basis. So we want to kick the can down the road on the basis. That being said, it's not a huge deal. And what I mean by that is, if you're, say, in the Eastern Corn Belt, or if you're happy with the basis, whether that's above historic averages or you can make the number work, or maybe your buyer doesn't do HTAs or basis contracts, it's fine to just lock in the beans. The other thing on the percentage, the 20%, the idea is we want to keep powder dry for the spring. Our goal is to haul those in the spring. But we have prices come up in mid-November, then they came back down. Now we're basically back up to those same levels again. And it's just prudent. What if this is the 2 peaks that we get out of the year? We want to make sure we're moving something. Doesn't have to go overboard. So in terms of volume, the recommendation is 20%. But think about it. Maybe there's quality issues, or you want to core your bins, or we're just chipping away at that volume, just getting an average started, not overboard, not overkill. The next table that I want to point out, this is what we've been tracking the last couple of weeks, which is we want to look at, okay, at current price of soybeans, and then given the historic normal ratio between corn and beans, what would be a range of prices that we could look at? So if we would say, okay, the current price of beans, let's lock that in, and then let's look at the ratio. At one end of the ratio, we would have 2.3. At the other end of the ratio, we'd have 2.7. So what range does that give us on corn? And we would see that it would go from 4.8 to 4.14. So with the current price of new crop soybeans, what could we expect out of a range on corn? And it's 4.14 to 4.87. And then the same thing, if we lock in corn at current levels, what would be our range? It would be 10.70 to 12.56. So the first thing is, if you would just think about the halfway mark between these prices, and I'm not going to do the math right now in my head. I probably should have written that down beforehand or something. But the idea is the 465, another 20 cents, we get to the upper end on the corn, right? We have $1.30 to move higher on the beans, $1.36 to move higher on the beans before we get the upper end of that range at the current price. What I'm trying to say is, if we don't get a soybean rally, it's going to be hard to get a corn rally unless that ratio completely gets skewed. But we'll be pushing up against the limit of that ratio unless we get beans to move higher. If we can get beans higher, all of a sudden we get wind in our sail for corn. So I just wanted that, think about it this way. At the upper end of the range, if you had a wish, and you can keep the price of corn the same, or you can keep the price of beans, but then you get to max out the other one. Would you prefer a 22-cent rally in corn, or would you prefer a $1.37 rally in soybeans? What would you prefer? And I think most people would probably pick the $1.37 in beans if they were choosing which one they would prefer, and they were looking at their revenue and say, man, $1.37 higher on beans, I'd probably actually plant a little bit more beans. And if we could get that type of move out of the bean market, I think we get some fireworks in the battle for acre. And that's important because of what we're going to talk about in just a minute here. Well, we're already going to jump into it. As we look at soybeans, there's two things. First of all is we have, if you look at this 100,000 contracts long, the speculators, they're already in the overbought territory. Wow, they're long more than 100,000 contracts on soybeans. But back in November at those highs, they were like 230,000. So yes, they are long. They're at 150 right now, just a hair over. But they could still buy. I mean, they can do whatever they want, right? But it would not be unheard of for them to go buy another 50 to 100,000 contracts. And that brings us to the next point. If we look at a price chart, let me shift gears here. We look at a price chart, and let me grab this here. Okay. At this, they were long 230,000 contracts. I can make that look a little better. They were long 230,000 contracts. And then here, they're long just a hair over 150. So what would happen to prices if they go by another 50 to 1,000 to 100,000 contracts? Let's say we add 50K contracts. What would happen? And that $12, that isn't too far away. That's just looking from merely a speculative point. Now, beans are toppy. Let's talk about that, right? A couple of things. Number one, this red bar here, and I'm going to zoom in on it. This red bar here from Friday's trade, this is a key reversal. We took out the high, took out the low, and closed down. That red bar from Friday, that is a key reversal. And then Monday came out, boom, new high, higher high, higher low. So this feels like an unstable market. Just for the sake of analogies, let's go back to November, right? We had a similar thing. We had a key reversal. And then look at that red bar. And then, man, we took out the high. And then, man, we took out the high one more day. But what was, when it was all said and done, what was the direction of that? It was down. So this is a very, I would put this in the category of a very frail rally, very frail market right here from a technical standpoint. It looks a little bit it looks a little bit like it did in November. It looks a little bit toppy. Now, do I hope it moves higher? Absolutely. If it falls, it's not actually horrible news. I'm actually kind of encouraged. So last time it fell, it was not able, if we look at November, it was not able to hold this first line of defense, which was the 200-day moving average. It actually fell all the way down here to the 20-day is up here. That's 20-day. This is the 200, right? So it fell hard last time in November, but we also had a really bearish headline, which was Brazil's crop. Here we are again, and we have this first line of defense that's probably going to work its way up. Then we have the second line of defense. And if we keep this strong, that 200-day, that's not far from that $11 mark, right? We're not too awfully far from support being $11. The other thing that's very important is at this rally, what was going to happen here? Brazil harvest, right? But at this rally, what's going to happen here? On the other side of this, and I'm going to run out of space, right? So what's going to happen there? U.S. planting. We're in the middle of harvest and we're rallying. Middle of harvest in Brazil. This is a fall, for lack of a better term, right? This is a fall rally if you think of South America. This is a harvest rally. All that's to say, perfect scenario, I'm not going to say, perfect scenario is we go up, up, up and away. But even if this soybean market falls, let's say it goes from the 1160-ish and it comes all the way down here to 1120. That's a significant fall. That's down 40 cents, right? That's 40 cents lower. But if it stays above this 20-day moving average, we actually have a somewhat well-supported soybean market. And I don't think seeing $12 beans is something out of the question this growing season, but that's an if, right? We have to get that support level. So what are we going to do in here? Exactly what the recommendations were. Make sure you've got a stake in the ground on the new crop, pretty significant stake in the ground. Make sure that you're out of your fall delivery bushels, that you're out of your winter delivery bushels. Just start an average on your spring delivery bushels. We're just going to pluck away at sales. Hopefully future sales bring our average up. But we're going to get our work done a little bit at a time. So far, we've been making good moves. If we fall down to support and we want to get long, well, that's a future decision. And as you look at basis, So do we have a basis chart here? Corn, let's see. Okay, we do have a basis. Okay, so let me mark this up. As we look at basis, and I actually selected the Western Corn Belt over here, that Northwest, because that Northwest Iowa, the Western Corn Belt has been the sad story, so to speak, on basis. The soybean basis has stabilized, so that doesn't necessarily point towards weakness in the market, but we are almost to historic averages, and it's just stabilized. It's not going up anymore. Beginning in March, though, and this is why we said the HTA, right? That's why we suggested the HTA. Beginning in March, that basis typically, historically would climb. And if that were the case, let's say that it goes from current levels to historic levels by the end of May. Let's say that it makes that jump. That's about a 30-cent improvement in basis. Now, I'm not saying that that happens, but that is a pretty significant climb right there. So that's the idea with the HTA. Lock in the futures. If you could get a 50 under basis instead of an 80 under basis, that makes a pretty big difference. Now let's switch gears back to corn, and let's start with the position managed money position last. So this is the corn. This is position of managed money with the corn. All right, let's grab a marker to get this cleared up. The good news is we have gradually seen this stair step. They're gradually reducing their net sold position. That's the good news. The bad news is they're still net short, and it's not really made much of a difference on price. We really need to get something to get speculators saying, gosh, corn needs to move higher. I want to buy corn. And that has not happened yet. What does that look like on a chart? If we pull the corn chart, we are, if you look at that big oversold position down here after the USDA report, the good news is it has gradually climbed higher, but we're talking what, a dime? This is not life-changing prices, right? 10 cents higher from the bottom tip to the, I mean, it's not, this is not changing anybody's budget significantly, right? You punch that the lower number in or the higher number, it's still not great. The good news from a technical standpoint is that it does seem like we are supported above the 20-day moving average. We also didn't go back to the harvest lows. That's good. So even on January, didn't go back to the harvest lows. I think honestly, here, we just ran out of sellers. It's just too cheap. I just can't do it. I think that's the sentiment. So if 10 cents cheaper is too cheap, are we really going to get selling pressure here? I don't think so. Hopefully we get some reason to get this corn climbing higher. But again, that bean market, if that bean market would lift the cap, lift the upper side, it would not take very much. So let's say that we get a pop up and new crop beans go to 11.50, 11.70, 11.80. So let's say that they rally 30 to 60 cents. All of a sudden, it'll be tempting to say, I can make money planting beans, right? I know that number is different for different operations, but man, you get beans closer to $12, all of a sudden the budgets work a little bit better. Maybe I don't need to plant all that corn. And if we could get a rally out of beans, I do think that pulls up corn, and it probably moves speculators into the corn market. And that's what can really get us a pop. Now, harvest prices, actual acreage, I'm not saying a projection on that. I'm just saying that if we had to have one wish, a bean rally, which very likely would trigger a corn rally, is very important. Where a corn is just struggling to move higher. There is a bullish story on corn, in my opinion, that's brewing in South America, because I am I do not think, with the delays that they have to double crop corn planting, I do not think they will hit their production objectives. But if we could get a pop in soybeans plus a weather scare out of South America and get a battle for acre and get some speculators excited about buying corn, maybe we have a story, right? That's maybe we're trying too hard, but we need something, and it's one of those things that just wait for the opportunity. So let's get the corn basis. There we go. Corn basis had been gradually increasing. Again, we're looking at the Western Corn Belt. We had seen the corn basis gradually increasing, but it's kind of plateaued, and it is a long ways under the historic average. I mean, we're talking historic average would be close to even by now, and it's not even close to that. We're 40 cents under. This is a big deal on corn. I've heard from customers that there's corn piles out in the Western Corn Belt. So there's a lot of corn out there, and it's hard to convince the market that you need to hurry up and buy corn if it's March and there's still piles of corn from last fall. Let's wrap it up with this summary and go from there. So seasonally, this is neither a buy nor a sell for corn, and for beans, it's also neither a buy nor a sell. Managed money for corn, they're net short, but not enough to justify buying. On soybeans, they're net long, and they actually are overbought, so it would justify selling soybeans into this overbought position by the funds. Corn is in an uptrend, and soybeans are in an uptrend. That's the good news. Basis. Basis levels in the Eastern Corn Belt continue tracking above historic averages for the most part. In the Western Corn Belt, however, basis is well below historic averages, especially on corn. And basis improvement has somewhat plateaued over the last several weeks. The soybean market looks toppy, much like it did at the end of November. But there is a major difference in the fact that the upcoming headlines are battle for acres in the USA, followed by USA planting, where in November, the following headlines were record-setting soybean crop out of South America. This may be reason for optimism. The corn market seems well supported above the 20-day moving average, but does not have the strength to mount any type of rally given the fundamental situation. Even if it doesn't quite sound like it, and even if prices aren't well, I'm somewhat encouraged that we will likely get a spring rally. We usually do, right? Saying, oh, we're going to get a spring rally. Yeah, the odds are in your favor. We usually do get a spring rally. But we do have prices that are pressured. We have a series of headlines that are yet undefined. Safrinha corn in Brazil, acreage out of the U.S., trade uncertainties, RVO approval or not. So you line up 2 or 3 of these headlines back to back that are bullish coming in to the uncertainty of spring, and there could very easily be a spring rally, right? So this is a scenario that is somewhat friendly or somewhat conducive to giving us the spring rally that we typically get, 70-80% of years. So I just want to make sure that we're, number one, ready for it. You know, we're positioned to benefit from a spring rally. And number two, that we're ready to act. Next week is March, April, May. We're coming into the big leagues, right? These are the times that we want to get work done. By June, we want to make sure that we're getting work done. June is one of the most important months for grain marketing, right? So we're coming into the time that really matters, and we have the potential for a rally. I'm not saying it's life-changing, but we could really use higher prices, and this is seasonally a lot of times we get it. I just want to make sure that we're all ready to capitalize if and when that opportunity comes. Have a great rest of your day, great rest of your week.